Ladies and gentlemen, got another stock analysis for you today. Today we're looking at none other than Disney, right? One that's been a pretty popular stock over the last year, really couple of years, can't lie to you. So all things considered, we're going to take a look at this because I feel like it's worth looking at. Obviously, I want to preface this by saying that obviously I have a pretty big stake in Disney myself, representing around 4% of my total stock market wealth, I suppose. Put that into consideration, but we'll be talking about this one today. I'll give you a price target at the end for both a year and 5 years out. Hope you enjoy this, and let me know if there's anything else you want me to look at. But let's take a look at Mr. Disney here, right? First, we look at the stock price. If we're analyzing something, first I want to see what the stock's been up to. Definitely worth looking. First, I would probably look year to date, and see that the stock's been pretty unfavorable year to date. This is obviously not a great sign because the market's been overall still in the green this year. We've had some stagnation, but year to date we should be seeing green on this company, but we're not. But when you look a year out, you definitely see a different story. The stock's up 48%, which still, all things considered, is not that ridiculously high, right? There's a lot of companies out there that are up upwards of 70 to 80% over the last year. So then we look 5 years out, and a different story is told here as well. So you see from their dip in 2020, the recovery's been quite massive, 100%. Still doesn't compare to a lot of stocks out there, I can't lie. And then I look at the years prior, from 2018 or 2016 to 2019, there was no movement. I mean, we're talking about a period of three full years almost, where we saw stock growth of 13%. Pretty minimal return prior to this. So definitely a stock that historically has not been as favorable as others. There's no doubt. Returns definitely not been as favorable. So we're going to take a look at some of the valuation here and see what kind of room we have to grow. Heck, over the last 5 years, the stock's only up 80%, which is actually quite low for a 5-year period in this market. It's pretty darn low. We look at some of the valuation we have going on here. Disney right now trades at a market cap of $313 billion. Not too bad. Trailing PE ratio and forward PE ratio are all both very high, and there's good reasons for that. Obviously, you can see where the shift started here. Look at as of March of 2020, you see where this stock was incredibly undervalued. 17 PE ratio, market cap only at 172, forward PE of 23. This stock was dirt cheap back then. Now, the stock's a lot more expensive, mostly just because of the fact that earnings have been pretty well crushed by really the pandemic. I mean, it's done a toll on this business, and it's affected their profit line significantly. So that's where you see the PE ratio getting kind of hurt there. But what isn't that bad here is going to be this price to expected growth. It's darn cheap right now for this company. If you look at the financials, revenue obviously has seen some decline. There's no doubt. There's not a shocking thing because you think about the core businesses here. Disney, where they make their money, they have a few different segments. They've got obviously the traditional media segment, which is going to be obviously from television and the like. You've got the studio entertainment segment, which is going to be obviously from theaters, where they get that kind of money. Parks and resorts, which that's a segment that's been completely shut down over the last year. From March of last year, really up until a couple months ago, completely shut down. They weren't able to do any business in that segment. So that's greatly impacted their revenue line. And that was their largest area of the entire company. And then we also have products as another segment too, and now their newest segment is going to be the direct-to-consumer segment, which includes their streaming services. So one thing to consider as well. So that's how they make their revenue there. And you look a company, what's the main thing here? So for Disney, I can't lie to you, the main factor right now is going to be Disney Plus. You look at some of these Disney Plus originals, it's a thing you got to look at. Obviously, just released with Loki, and I mean there's originals everywhere. You see, are coming soon. Pretty fun stuff. There's some original series of classic bangers that you used to love. Um, Obviously, Monsters at Work, based off of Monsters Incorporated. You gotta love that. I mean, you look at that's right. Turner and Hooch, what a banger! What a banger with Josh Peck. Get that out of here. Ew. Sorry, I didn't know they were making that, but that kind of disappoints me. Josh Peck, he's all right, I guess. He's all right, but I mean, look at these movies. Look at these movies. Star Wars, Marvel, Obi-Wan Kenobi series. They got it all. They have pretty well everything you could imagine. It's just banger after banger after banger. Hawkeye. I mean, good grief. Good grief. I mean, Groot. I mean, they got it all. That's the thing. More Star Wars. These are all going to be series or movies that they're making specifically for Disney Plus, and this gets a lot of people interested. One thing that Disney Plus does, I would say, arguably better than any other streaming service out there, is their originals. This is a company that struggled with originals early on. They didn't have a lot of originals, and they saw growth slow because of that. But now they've announced a massive slate of originals for this year and next year that are going to be incredible in bringing people on. That's one thing you need to consider about some ways these companies do these things. So typically, some companies, when they release a show on a streaming service, they'll release every single episode all at once. So that way someone could technically binge that within a week's period or a day's period if you're, that. But if they were to do that, which would be rough, then they could just unsubscribe after a month of subscription, right? And if you're not keeping up with originals, you're not going to keep them on. But Disney's pretty well every single month got one or two originals releasing, and they release them every single week that they release the episodes. So they're pretty well forcing people to stay subscribed if they want to watch this, right? If they want to watch it new, at least. If they wanted to wait and binge it all at once, they can. But with new and upcoming shows, they're going to have to stay subscribed. So pretty smart idea. They're really encouraging that annual subscription to keep people locked in. That's what I like about them. And obviously you have your parks and travel segment. Not a shocker here with crazy stuff. 50th anniversary on, fun stuff. October 1st. That's quite crazy. We have the new Star Wars segment. Toy Story Land, I mean. They've got a lot of cool new attractions that they've added. Star Wars Land being the most recent one. Curious what that looks like. I've seen some videos of it, and it seems pretty freaking cool if you're into that kind of stuff. If you're not, you're not. But again, we're talking about the cruises, all of this, the resorts, all of this was shut down last year, and we're finally opening up. We have opening up everywhere, right? Capacity already set to increase. As of May, they were increasing capacity to 35%. And that's going to keep continuing to grow, and eventually they'll be able to go to full capacity. And people are really excited to go to Disneyland, I can assure you of that. People are they want family vacations. They didn't have family vacations last year, and they're going to have them this year. So Disneyland's the place to go. And obviously from a movie segment, and then they have a product segment too. But that's Disney as a company for you. One thing you need to consider, because you wonder why the stocks had some stagnation. And I find myself curious in that aspect too. So you look at these results. This is from the full year of 2020. And I see things that shock me. First, you look at the media network segment. Nothing crazy. Change of 14% growth. It's not crazy. Obviously, they increased their total assets by acquiring 21st Century Fox. What you see here, which is wild, the parks and entertainment segment here, this used to be the largest segment they had, $26 billion here. It shrank to $16 billion last year. So you think about the growth of $10 billion extra dollars they could add to their revenue line right now, and even probably higher, because this is an area that was still growing. It'd be crazy. Studio entertainment down 13%. because movie theaters were down. Now, one thing I need to preface here, there's negatives here with studio entertainment. I believe the era of the theater, frankly, is dying. I mean, I don't think anyone can deny that. If you've been to a movie lately, no one's going to movies. They're not. At best, you might see the 8 p.m. crowd potentially go see some movies that are new. Obviously, there haven't been new movies all last year, but now there are, and people still aren't really going. You see the hits like A Quiet Place 2. That should be a hit movie. Only brought in $57 billion on its opening weekend. I mean, that's light. 57 million is 57 million is light. Compared to what these companies used to be doing for these movies. So that's an area I believe still going to show weakness. I think regardless over the next few years, because every company's also launching on streaming. They're all launching their movies on streaming at the same time. Now Disney's typically charging a premium, which benefits them because they're getting way more than they would get if they went to theaters for them. Big time, right? They're probably getting, I would say on average, I don't know, $10 a showing to let the theater show them, something around there. Whereas here they're getting guaranteed $30 if someone visits it, because they're charging $30 typically for this charge here. They're guaranteeing themselves an extra $30 on top of their Disney Plus revenue that they're already getting for the subscription. So pretty crazy to see there. And that's where you see Disney Plus here is this direct-to-consumer number here. This is incredible growth, 81% year-over-year growth from this segment, and it's one that's only continued to grow. So this is likely this year going to become the largest segment they have. It was technically last year too, but that's because the parks was devastated. As parks grows back, direct-to-consumer is going to take over. It's going to take over as the number one segment, no doubt. Now, expenses are certainly going to go up quite a bit too, because you talk about all the originals they're going to have to put up on Disney Plus. Originals are going to make expenses up. Just consider that. And obviously I wanted to bring up what they did most recently here. As of April 2021, obviously release results next month, I believe. But you see they've done some segment consolidation. Direct-to-consumer here, if you look at 6 months ending, already did $7 billion, right? 65% growth over the 6-month period it faced last year. Just incredible growth. I mean, that's the main way to say it. It's incredible growth. Linear networks stayed flat, which isn't a shocker as well, but that's what I think is incredible. And the parks segment, down 49%. I mean, you talk about the money they could be doing with that parks and experiences segment. Once that comes back, this stock's taken off. Now, what shocks me, the stock, again, there's positive news. We have reopening, yet this stock hasn't seen that positive influx. Year to date, not much going on. Overall, in the last 5 years, the stock's up only 80%. Not only have they launched one of the biggest, really the second biggest streaming service on the planet, they've also now, they're reopening their parks. Yet the stock hasn't seen much movement because of it. You saw the bump because of Disney Plus here. This last year, this bump was Disney Plus. And then since then, Disney Plus hasn't stopped growing. It hasn't. This is a company that's by far blown away their estimates for for subscriber numbers consistently. And the stock's gone down since. I mean, I don't know what to say here. And the parks are opening up. I don't know how this is possible that we've seen downward movement over the last few months on this stock. I don't see how that's possible. So let's get into my price targets for this one. And obviously, I'm pretty fair with these, I'd say. I count for positives, negatives. So I've got a high target, my personal target, and a low. For 1 year, I can't lie to you, I'm not incredibly bullish on this company for a lot of reasons. I think there's overall a general downturn in the market, kind of headed our way. I think there's chance, just given everything going on and maybe some bad policies being made. We'll see what goes on, but hate to think that things could be bad, but My high target on this one is only $200. Now that's not a significant growth from where we're at right now. We're sitting at 172 right now. Still would be great growth for a year's period, in my opinion. To grow the stock to $200 would be pretty nice. I personally think it'll be ending around 190. So I think there's some positive still in this. And I think when people start returning and we start expanding even further the opening of these parks, I think that maybe, and again, this all depends on if investors use their brain or not. Right now, I don't think they are. I think investors are very short-sighted. They don't see the company for what it is, unfortunately. And the low I put as 170. I think this stock could stay stagnant the whole year. This is a stock that's had a history of stagnation. It really has. There was a period between really 2018, or I should say 2015 and 2019, where it moved 10%, right? Minimal movement over, 2% annualized growth rate over that time period. And trust me, I held it around that point because that's when I bought in. I bought in 2016. What did I buy in 2017? 2017? When did I start my 2017? I bought in 2017, and it already was stagnant before then. So I know this. I've had a history with the stock where it moved nowhere. Disney Plus was the only reason it moved at all. But again, I think my target's a little bit closer because I do think there's still green in the market. I really do. I believe this market should end higher than it is. I think Disney will just go along with it. I just don't think it's going to catch fire like it should because I think investors are a little bit short-sighted still. Now, my 5-year targets, I included market caps here so you have an idea what my ideas are here. So my high target I put at $350. That puts this company at a $637 billion market cap. So put that into consideration. The company right now is at a market cap of $313, making revenue this year probably closer to $65 billion. So that puts it valued around, right around 5 times that amount there, right? Nothing super crazy there. Now we're talking about doubling the market cap here. If we're putting it at 637, we're doubling the market cap. Now, will the revenue double in that 5-year period? I personally don't think it will. And I don't think it's fair because I think right now the stock's trading very cheap. When you're talking about 5 times the market cap compared to its revenue, I think that's trading cheap for a company that's got, you look at the other streaming companies and what they're able to pull in terms of these valuation numbers, it's incredible. Now, Disney, because it's always been a traditional company that hasn't been seen as that, it's always been seen as a value play. It hasn't been seen as the growth play. So it hasn't gotten that valuation boost, in my opinion. I think down the road it will. So I think, obviously, revenue, probably by that time, I'll be fair, and I think I'll give it an estimate of around $100 billion in revenue, which I think would be incredible if they hit that number. But I think they could do it. I think they could grow their revenue by $10 billion a year, potentially. But it'll take some growth, all right? It'll take a lot. It'll take the park coming back. It'll take Disney Plus continuing to release a lot of originals. But I think it's 100% feasible that they're able to do that. But again, this is really saying that people start to value it to where it belongs to be valued, in my opinion. I think it should be valued there. We're talking about doubling the stock from where it's at right now, 100% growth. My personal target's at 265. It's a market cap of 482 billion. Where do I get that number? Well, I think it's not incredibly crazy to say it keeps the same 5 times valuation that it's at right now, and it just continues to grow the revenue from where it's at, closer to $80 billion. That's my, potential. I think that's a very fair case there. Right around $80 billion in revenue, still trading around 5 times. I think will put us closer to this $482 billion market cap. I think it's feasible, right? I think it's feasible. So 265 is my personal target, and my low's at 200, which is only a 364 billion market cap, which again compares to a 313. It's very minimal growth. We're talking about the stock really going through quite a period of stagnation where it's only going up a total of 20 right around 15% over a 5-year period, which, again, it's not foreign to the stock. It's not, because sometimes investors look at this as just a value play. So it wouldn't shock me, but that's what I got for you today. I hope you enjoyed this. Let me know if you have any critiques, comments. What do you want me to look at next? I hope you have a good one.